Very good morning, friends. So welcome back once again to the classes on financial instruments. So we were talking in terms of Index 32 so far, and today also we're going to carry forward the journey in terms of Index 32. So I think before we start off the day in terms of our deep discussion on compound financial instruments with you, I've given you a few MCQs to try in the previous class. So I think first we're going to answer those MCQ questions to you. Then I'm going to take the journey forward in terms of our detailed discussion on compound financial instruments today. So let me first of all bring you to the questions which I gave you in the previous class. And I think let's have a little look at the questions with you. The first MCQ which I gave you was that if the mode of payment, MOP, is cash, we are not concerned whether it is a derivative or a non-derivative. Now, if you rightly remember, the concept of the fixed test for a non-derivative and the concept of a fix for a fixed test for a derivative is applicable only if the mode of payment is supposed to be equity shares. Now, if I say the mode of payment is cash, then yes, we are technically not concerned whether the contract is derivative or non-derivative in nature. So when I say that if the mode of payment is cash, we are not concerned with whether it's derivative or non-derivative. That is absolutely true in nature. Correct. Okay, so let's take this further. The second one which I said was if mode of payment is equity shares, we are concerned with whether it is a derivative or a non-derivative. I think that indirectly gets answered when I took up the question number one, because if the mode of payment is equity shares, then yes, we are definitely concerned whether the contract is derivative or non-derivative, because accordingly you would apply the fixed test or you would apply the fixed for a fixed test. Okay, this is also a statement which is true. So the first two questions are true. Then the third question says if mode of payment is equity shares, we apply a fixed test only. Now, when it says the mode of payment is equity share, that stems out of my question number two itself, that if I have to apply a fixed test always, then there is a question of a derivative or a non-derivative in nature. So I think first we need to decide that it's derivative or non-derivative, and then accordingly we take a call whether it's a fixed test or it is going to be a fix for a fixed test. So this statement is false because we need to consider either a fixed test or a fix for fixed test depending upon the nature of the contract. Then there is a question number four, which I gave you, that if all the three characteristics of a derivative are met, only then it can be called as a derivative. Now, we said for a derivative, there are three parameters, or we can say three characteristics, and you need to definitely meet all of them. A failure of even a single condition would mean that it's not a derivative in nature. So when it says all the three characteristics needs to be present, only then we can call it as a derivative. Absolutely true. So the first two are true. The third is false. The fourth is also true. And finally, we've got the MCQ number 5. Fix for fixed test applies to a non-derivative contract. I think they're quite interrelated questions, testing you from all the corners. So when you say the fix for fixed test, it's applicable only to derivative contracts. So it does not apply to non-derivatives. To the non-derivatives, we apply the fixed test. So this statement is supposed to be false. Right. I guess you've been able to check up your answers on this as well. Okay, I've got some good answers coming in from Rashmi, Manini, and great. Wonderful indeed. So good try indeed. Okay, so I think this takes care of our warm-up exercise for the day. We're being answered the MCQ which I gave you in the last class. Okay, now before we take the journey forward, I think let's first of all map our minds in terms of a quick review. What is the chain of thought going in the mind? How are we progressing? So a little consolidation. I'm not consolidating the steps, only consolidating the coverage we have done so far. Well, I guess, first of all, let me remind you that we started a journey in terms of that there are a total of 3 standards dealing with financial instruments. And my focus has been on Ind AS 32 so far. I'm still on Ind AS 32. And I've been looking at this standard mainly from the issuer point of view so far. We've not been discussing the concept of holder. So I've not even taken up the definition of financial asset. But as far as the definition of financial asset is concerned, it is purely a mirror image of the definition of financial liability. So I think I'm going to, before discussing the compound financial instruments, we're just going to make a quick run through on the financial asset definition as well. So when we started the journey in terms of Ind AS 32 from the issuer point of view, we first of all decided that when you look at an instrument from the issuer point of view, it is either supposed to be a pure financial liability or it is supposed to be a pure equity instrument. Now you would understand why I'm saying a pure financial liability or a pure equity instrument, because I'm referring to the concept that they are non-derivative in nature. Then we covered the aspect that it's a pure compound financial instrument, which is supposed to be a non-derivative instrument in nature. And we've also seen that it could be a compound financial instrument with a derivative embedded in it. So we can say that typically we've seen 4 kinds of instruments from the point of view of the issuer. So either he lands up saying that it's a financial liability, or it's an equity instrument, or it's a compound financial instrument which is comprising both of financial liability as well as an equity component, which we saw slightly. How do we do a split in terms of the split accounting? Today, of course, we'll get into more detail in terms of how the compound financial instrument is going to be split in terms of the liability as well as the equity component. Then there is a compound financial instruments which, depending upon, could be segregated in 2 or 3 components, which we've already discussed. But when it comes to the point of view of the holder, he would always land up saying in all these cases that it is supposed to be a financial asset. So I think first we'll also look at the definition of financial asset today, because I've already given you a 3-step model. And in terms of the 3-step model, we've seen things purely from the issuer point of view, wherein we've seen when do you say it's a financial liability or it's an equity instrument or a compound financial instrument. And along with this, I've also given you a total of 5 charts as well. And in these particular 5 charts, which I covered in the session 1 and session 2, I have given you a total of 3 + 1 + 1 chart. In order to elaborate my 3-step model, I've given you a total of 5 charts so far. 3 charts I gave you on a non-derivative, wherein the first one was when the mode of payment is supposed to be purely cash. The second, when the mode of payment is supposed to be purely equity shares. And the third chart, where the mode of payment is a blend of cash as well as equity share. Then I give you a chart number 4, where I introduced you to the concept of a derivative, and this chart was concentrated on a derivative. And then I gave you another chart, which was supposed to be typically on hybrid contracts. Because when you're referring to this kind of instrument, which is a compound financial instrument, where there is a derivative embedded, this is nothing but it is supposed to be a hybrid contract. So I give you a chart in terms of a hybrid contract where there is supposed to be a non-derivative and there is a derivative embedded in the contract. So this has been the journey so far, that we've concentrated on a 3-step model supported by 5 charts, which gave us, from the point of view of the issuer, how do you present an instrument in the balance sheet of the issuer. If it is supposed to be an equity instrument, it comes under the head equity. If it is supposed to be a financial liability, it comes under the head, you can say, borrowings, financial liability on the liability side. And if it is a compound financial instruments, you got to split the debt, that is financial liability, and the equity element. The equity element appears as a part of other equity in the balance sheet, which is supposed to appear in the SOKI as well. We'll be talking very shortly on SOKI, not today, but maybe later. But then we'll come to the aspect that whatever enters in the other equity is reflected in terms of the detailed statement, which is called the statement of changes in equity. Okay, so this has been the journey so far. I thought before I take it further, we at least stand at the common platform that this has been the chain of thought of a coverage. I hope everybody is quite comfortable so far, whatever we have covered, right? So based on this now, I am going to take the journey forward. So first, let me come to the concept of financial asset. So first, what I'm going to do, I'm going to first of all cover up the concept of financial assets because we identified three terms in financial instrument definition. One is a financial liability, one is an equity instrument, and the other is financial assets. We've already covered the concept of financial liability and the classification of equity instrument. Now let's also focus upon financial assets, because here I need to give you at least one important aspect, before we go to the Ind AS 109, but of course not today. Today is going to be a concentration on Ind AS 32 itself. So let me do one thing. Let me first come to the study material with you. And in the study material now, I'm looking at the definition of financial assets. So this is the unit number 1 of the study material. And I'm looking at the definition of financial asset, which is given in Ind AS 32. This is the unit number 1 in the study material, page 12.6. So if you're referring the page, let me again put it again, page 12.6. We're referring this on page number 12.6 in the study material in unit number 1 of financial instruments. So let me, I think, first read the definition to you. Well, we can notice in the definition of financial assets, there are a total of 4 clauses, A, B, C, and D. The clause A says that financial asset is any asset that is cash. Cash is the medium of settlement. It is undoubtedly a financial asset. Then it says in point number B, an equity instrument of another entity. So if you invest in equity instruments of another entity, it is supposed to be a financial asset. We'll talk a little more on clause number B, but before that, let me show you the clause number C. Trust me, the clause number C is nothing, but it is a cut, copy, paste in terms of a mirror image in terms of the clause A of financial liability. If you remember the financial liability, it said a contractual obligation. Now here it says it's a contractual right. Then there was a clause number B of financial liability definition, which says settlement in terms of own equity instruments. Here, the clause D is a mirror image in terms of the clause number B of financial liability. So basically what you have covered in financial liability, clause A and B, is a mirror image out here, clause C and D. The only additions in the financial asset is the cash, that is clause A, and the contractual, you can say the equity instrument, the investment in equity instrument. So I'm going to concentrate only on the clause number B because I want to give you little inputs at this stage on clause B. Now, hear me very carefully. Hear me very carefully in terms of the clause number B. Now, when I say that there is an investment, when I say that there is an investment in equity instruments of another company, I would categorize these investments into 2 broad categories. One is we can say that it's a related party investment. One is I can say that it is a related party investment, and the other is I can say it's an unrelated party investment. Mind the words very carefully, because this is where sometimes people tend to get confused. Because I'm going to give you a broader idea, because in between the financial instruments, I'm also going to make you run through on a practical balance sheet as well, because I think whatever you're learning today, you should be able to apply this in a practical life as well. So I'm going to definitely connect you to a practical balance sheet, but not now. The stage will come and I'm going to definitely connect you out there. So when I say investment in equity instruments, we can say there are two kinds of investment. One is, you can say, investment in a related party. Now, when I say there is an investment in related party, we are making reference to a subsidiary. We are making a reference to a joint venture. We are making a reference to an associate company. A company where the investor has got a control becomes your subsidiary. A company where you get a joint control becomes a joint venture. A company where you've got a significant influence becomes your associate. So when you control a company, it's your subsidiary, a related party. When you've got a joint control, it creates a JV. And when you've got a significant influence, it creates an associate. Now, let me tell you, though the definition says investment in equity instruments, but the interesting part is, if you look at the scope of the standard, the scope of the standard says that these are scoped out. These are scoped out. That means if you've got investment in equity instruments in related party, then it is not covered under financial instrument standard. Index 32 and Index 109, specifically, I would say 109, is not applicable. So the moment you're making investment in related party, you are not covered under the purview of this standard. So then, which standard are we going to get covered in this particular case? Well, in these cases, we are covered by Ind AS 32, Ind AS 27. The moment you make investments in related parties, you are covered by Ind AS 32, which is called separate financial statements. It is called separate financial statements. A company which has got investments in any of these three, subsidiary, associate, or a joint venture, is supposed to apply the concept of Index 27. Now, what does Index 27 tell you? Index 27 says that if you are supposed to measure these investments, now I'm going slightly to the measurement concept. The Index 27 says that if you want to measure these investments, you've got a choice of either measuring the investment at cost, or you can measure them at a fair value. So if you look at the inputs which are given in terms of Index 27, it talks about that you've got a choice in terms of measuring these related party investments either using a cost model or using what we call a fair value model. Great. Now, another interesting thing. The moment you are covered under Ind AS 27 and you measure the investment at a fair value, the moment you measure them at a fair value, this brings you back to Index 109. It's very interesting chain to watch. The moment you consider that you are covered, you want to apply the fair value concept, you come back to Index 109, because if you choose to apply a fair value, then you are covered back in 109. So it's a very interesting situation where Index 109, first of all, scopes out the investment and says, I'm not applicable to you. And then you enter Index 27, and Index 27 again, scopes in the particular investment. So which means that if I want to get a clarity of thought, I can say that if you make an investment in a related party, I would say on the face of it, Index 32109 not applicable. You got to apply Index 27, which gives you a choice of a cost model or a fair valuation model. But if you choose the fair valuation model, you come back to Index 109. But if you choose a cost model, then I don't come back to 109. I hope I've made myself very clear on the picture. This was like connecting the definition with the scope of the standard, that you know it very clear that investments in related parties is not per se covered under 109. Only if you choose a fair value, then you get covered under 109. Now, let's come to the other chain of thought. If you make an investment in an unrelated party, this is called a passive investment. This is called a passive investment. So you become a passive investor. You become a passive investor. In this particular case, there is no control, no joint control, no significant influence. In this case, yes, Ind AS 109 is applicable. In this particular case, Ind AS 109 is certainly applicable in this particular case. You will be covered under Ind AS 109. And let me tell you something in advance. Though we have not covered 109 so far, but let me tell you that in this case, you would apply only one measurement base, and that is called a fair value. There is no concept of a cost model applicable to equity investments. If the company is making an investment in unrelated parties, you're definitely covered under the purview of Ind AS 109. And in this particular case, the only model which is applied is called a fair value. Now, I think if this doesn't become too technical indeed, I think I would like to take this a little further as well and tell you something more. Because as we go to progress to Ind AS 109, things will become slightly more technical, but very interesting at the same time, trust me. So interesting and technicalities go side by side. So let me just add another small little inputs to you at this particular stage. And I think let me just add on. Now, once we got the chain of thought very clear that related party investments covered under 27, but if you take a fair value, you come back to 109. Unrelated party investments is covered under 109. Now, let me also tell something extra at this stage. If you look at a related party investment, if you look at a related party investments and you've taken a cost model, in those particular cases, we will have to apply an impairment testing. So impairment testing would be applicable to related party investments if they're taken at a cost model. Interestingly, if you choose a fair value model for related party, or if you choose a fair value for unrelated party investments, there is no impairment required. The moment these investments are taken at a fair value, there is no impairment testing which is required for these investments. So a very interesting situation. That if you've got investments in related party taken at a cost model, impairment is required to be done if, of course, there are parameters. But the moment you choose a fair value for related party, and you definitely choose a fair value for unrelated party investments, no impairment is required to take place in this case. Wow. So I guess I've made myself very clear on one of the aspects of the definition of financial assets, because everything else is exactly, you can say, a mirror image in terms of financial liability. So my focus has been only on giving you a clarification regarding the investments in equity instruments with respect to the scope of the standard. Okay. Now, since we have discussed the definition of financial asset as well, I think let's have a look at one of the illustrations in the study mat as well, wherein we'll just identify whether it is a financial asset or not. I did one of the questions with you in the study material earlier, where we just made a quick review in terms of whether it's a financial liability. A similar kind of illustration is given in unit number 1 of the study mat. So let me just bring you back on the study material. So I'm on the unit number 1 of the study mat. And in the unit number 1, I'm looking at the example number 1. So I'm looking at the study material example number 1. This is in the unit number 1 of the study material. So let's have a look at this particular example just to get a little more clarity of thought. Now, we are given certain items and we'll just identify that whether it's a financial asset or not. And then we'll also look at the reasoning in terms of why it is a financial asset. Investments in bonds and debenture. Definitely, there is a contractual right to receive cash. It is a financial asset. Loans and receivable, again, financial asset with the same logic. Deposits given, trade and other receivables, they're all financial assets for the same reason that you've got the contractual right to receive. Then it says cash and cash equivalents, specifically a part of the definition, which is the clause A of the definition. The bank balance is again a financial asset with the same logic that there is a contractual right to receive. Then it says investment in equity shares. Now, you know this even better, that investment in equity shares depends. If you read the definition along with the scope, you would say it depends. You would say, okay, if it is a related party, then I'm applying Index 27. And in this particular case, if you choose a fair value, then I'm back to 109. If it is an unrelated party investments, yes, it is covered. But let me tell you, investment in equity instruments is, of course, a financial asset. Don't be under the confusion that there is investment in a related party, that it's not a financial asset. No, it is a financial asset. If you make investment in equity instruments, whether it's a related or unrelated party, it is certainly a financial asset in both cases, except that a related party investment, in spite of the fact that it's a financial asset, is not covered under 109. I hope I've made myself clear. Then the next one is perpetual investments, perpetual debt instruments. And I think we've already seen that perpetual debt instruments are financial liability. So in this particular case, it definitely becomes a financial asset from the holder's perspective. Now comes some very interesting input. And I think if you've already seen the balance sheet of a company, the Schedule 3, I'm referring to the Division 2 format in a balance sheet. It is very clear in the balance sheet format itself that they've segregated the current and non-current assets, one, and then they've segregated the financial and non-financial assets very clear. The demarcation of the assets in terms of financial and non-financial is very apparent in the balance sheet in Schedule 3. Now, there are certain assets, let me tell you, which will never create a contractual right to receive, but they would rather create an opportunity to receive. Like, for example, if you've got a property, plant, equipment, a PPE does not generate cash. I mean, in the sense it generates cash, but it doesn't create a contractual right to receive a cash. It only creates an opportunity that you would be able to generate cash. So all those assets, like the physical assets, if you're looking at, if there is an inventory, or if there is a PPE, or if there is an intangible asset, or even if it is a leased asset, what we technically call ROU asset, that is a right of use asset, they're all supposed to be assets which are non-financial in nature. Because all these assets will not give you the right to receive. They don't create a contractual right to receive, but they only create an opportunity to generate the economic benefits. So if you look at the point number 9, physical assets like PPE, inventory. Point number 10, there is a right of use asset. We call it as ROU asset. Intangible assets, they're all supposed to be non-financial assets in nature. Even if you look at the balance sheet format, you'll see these items very clearly depicted as a part of the non-financial assets. Then there is a point number 12, and I would say point number 13, where it says there is a prepaid expense and where it says advance given for goods and service. Remember, when we were looking in terms of financial liability, we were looking in terms of that there are two modes of payment. One is cash and one is equity shares. Similarly, financial assets will also have two modes of receipts. One is in terms of cash and one is in terms of equity share. So if you're looking in terms of prepaid expense, you would be getting the benefits in the form of goods and service, not in the form of cash, not in the form of equity shares. Similarly, if you're going to advance in terms of getting goods and services, then also we're going to get goods and services in return. So if your mode of receipt is supposed to be goods and service, not cash, not equity shares, it cannot be a financial asset. The same logic we applied in terms of financial liability. Right, I think that takes care of the insight in terms of the financial asset definition as well. So I think when we started off with financial instruments and gave you 3 terms, one is in terms of financial liability, we're done. equity instruments, we're done, and financial assets, we are done. Okay, so I think this takes care of my first phase on the standard. Now let's get on to the second phase with you. Okay. That's right. I think, Marandi, you rightly said that we're looking at another entity. That is absolutely correct. Okay. Now I'm going to change my focus of discussion, and I'm now going to very, typically I would going to, I'm going to make a discussion on compound financial instruments with you and on the hybrid instruments. Because I've generally seen, people just tend to get confused on the split accounting concept of compound financial instruments. I don't know for what reason, but this is one of the very important areas in the examination as well. You invariably get questions on compound financial instruments in the exam. So I think let's start giving you clarity on that area. So now we are switching over our discussions, and I am now going to concentrate on the concept of split accounting applicable to compound financial instruments. Now, let me, I think, first of all, tell you one thing before I make my deep discussion on compound financial instruments. I would cover this compound financial instruments in 3 sections. Now, I know, people at times tells me, sir, is 3 your favorite number by any chance? No, it's not. So you must be wondering that, this man is always speaking in terms of a 3-step model. And now he's saying that the compound financial instrument discussion we will make in terms of 3 sections. Well, it's just a chance. But you're going to see a lot of these chances happening. So I'm going to basically do my discussion on compound financial instruments in 3 sections with you. The first thing what I'm going to discuss with you is that how do you identify that it's a compound financial instruments? Sir, we've already covered that. Yes, you're right. We've already covered this particular aspect. How do you identify that it's a compound financial instruments? But we'll still pick up a few questions from the study material. That how do you identify that the instrument is a CFI? That is one section. Then second, I'm going to cover the aspect of what we call split accounting. That once you've identified that it's a compound financial instruments, then there is a need to split the financial liability and the equity component on the instrument. So how do we do that? We're going to cover that as well. And then finally, I'm going to cover a little special issue with reference to the compound financial instruments. And this is what we technically call an early redemption. Sometimes what happens if you studied, strategic financial management, and if you've got the opportunity to learn the concept of bond, there is a chapter which is there on a bond valuation. It explains the concept of an early conversion and early redemption, because sometimes the company might have raised funds from a particular instrument, but the market rate of interest is on the decline. So what the company wants to do, they want to switch over from their old funds into new funds. So they might induce the holder of the instrument that let's go in for early redemption of that instrument. So how do you tackle the case of early redemption? That's going to be a 3rd section. In the study material, you'll see that they very appropriately covered these 3 sections on a step-by-step basis. So the compound financial instrument section, which is given in the study material in unit number 3, because if you look at this, we are covering the unit number 3. I've not covered the unit number 2 as of now. That's dealing with 109. So in unit number 3, they've discussed on 3 stages. Number 1, how to identify it's a CFI, though we have covered that. Then we'll do the split accounting concept. And in terms of split accounting concept, I'm going to give you a lot of exposure on different permutation combinations, wherein we will discuss the concept of a perpetual debt instrument, wherein I'm going to cover the concept of a mandatorily convertible debentures, for example, what we call CCD, compulsory convertible debenture or mandatorily convertible debenture. We're also going to look at the concept of what we call the OCD, optionally convertible debentures. And we're also going to cover the aspect of what we call PCD, that is partially convertible debenture. So we're going to get a look at the compound financial instruments of different category when it is an irredeemable debt instruments, or there is a compulsory convertible debt instrument, or there is an optionally convertible debt instrument and a partially convertible debt instrument. I'm going to basically take 4 situations with you, and we're going to pick each one of them and learn the art of the initial accounting as well as the art of the subsequent accounting till the date of, you can say, conversion or the payment of cash, whatever the case might be. And I'm also going to give you a connect in terms of the Schedule 3. Because in terms of the compound financial instruments, you've got to be very clear, not only on the split accounting initially, but also the accounting subsequently, and also what's going to happen in the Schedule 3 balance sheet and the statement of changes in other equity. So everything will get connected today. Trust me, you will come out very clear with the concept of compound financial instruments by the end of our discussion. T&C apply, terms and conditions applicable. Okay, so I think let's start the journey in terms of these 3 sections with you, how to identify that it is a compound financial instrument. So I'm now going to take you to the questions in the study material. And after I'm done with the questions, I'll give you a mapping also so that you get more clarity on CFI. So let me start the journey. So I am coming back to the unit number 3 now. I'm on the unit number 3 of the study material, page 12.11. So please make your references to page number 12.111. This is on the unit number 3 of the study material. So I'm working on the first section, how to identify it's a compound financial instruments. Let's look at the illustration 27. And you will see that all these examples we've already covered earlier. And it relates to either the concept of the chart number 1, 2, 3, or maybe the chart number 5. You're not going to see any of these examples relating to the chart number 4, because chart number 4 was totally devoted to the concept of a derivative instruments. Okay, so let me, I think, begin the journey with illustration number 27. It says in the brackets, continued from illustration 2. So you know that we've already covered this in terms of unit number 1. Now we're looking at the same illustration in terms of the unit number 3. X company issuer issues debentures to Y company holder. The debentures are redeemable at the end of 10 years from the date of issue. You know that if there is a redemption at a specific date, then it becomes a financial liability component. Then he says the interest is payable at the discretion of the issuer. So we know that if the interest is discretionary, then it gives rise to equity component in that. So the principal element is redeemable, FL, and the interest component is equity, discretionary. Therefore, it becomes a compound financial instrument. The rate of interest is commensurate with the credit risk profile of the issuer, and we've already seen that this is supposed to be a case of a CFI. So I think I'd just like to make a mention out here, illustration number 27, just to give you a connect now. So if you look at the illustration number 27 of the study mat, then we can say in this particular case, I have the principal component and I have the return component. And I'm deciding on the nature of the instrument. And we know that in terms of the principal component, this is supposed to be a redeemable instrument, giving rise to a financial liability element. And the return is discretionary in nature, giving rise to an equity component. So FL plus equity will make it CFI. Let me now also tell you something more. I want to make a little more analysis on this particular illustration. Can I say, if you look at in this particular case, the mode of payment is supposed to be cash. I am nowhere given in the question that there is a payment which is in terms of equity share. So I'm not concerned whether it's a derivative or it's a non-derivative instrument. But let me tell you, this is undoubtedly a non-derivative instrument. Though, if the mode of payment is a cash, I don't need to identify whether it's a derivative or a non-derivative, but just for understanding point of view, I'm telling you that the mode of payment is cash and it's a non-derivative instrument. So this is an example of a non-derivative instrument, though the mode of payment is in cash. I guess I am pretty clear on this. If you've got any troubles in between, do stop me there and then. Okay, so this is done. Now let's have a look further. Let's come back to the study mat. So now we are looking at illustration 28. Now we've got the illustration continued from illustration 3, unit 1, illustration 3, and illustration 28. It says P company takes a loan from Q company, and the loan is perpetual, irredeemable. And it says entitles the holder to a fixed interest rate of 8%. Now, if you remember, I gave you in chart number 1 that if there is a irredeemable instrument with a mandatory return, then you should start comparing the contracted rate and the market rate. Friends, I would advise, as I said earlier as well, that, when you're looking at this financial instrument standard, please revise it carefully and, please attend the first class, second class, third class, everything in a row. Because many times what happens, we feel that, we missed out some portion, we'll do it later. Let's continue with the CFI. But I would advise go on a chronological order. The strength you will get on the subject is going to be super. So you need to go on a chronological order. So when I covered the concept of the chart number 1, in the previous class itself, I gave you that if it is an irredeemable instrument, a perpetual instrument, but there is a mandatory return on that component, you need to see that the interest rate contracted and the market rate of interest is same or not. Because if the contracted rate and the market rate is same, I said it becomes a financial liability. And if the contracted rate is less than the market rate, only then it'll become a compound financial instrument. Now, in this particular illustration, nowhere does it mention that there is a market rate of interest which is more than 8% or not, but I am presuming in this particular case that the market rate of interest is supposed to be greater as compared to 10%, then it becomes a compound financial instrument. So let me just come back to the illustration 28 and map this to you. So if I'm looking in terms of illustration number 28 now, so we can say in this particular case, we can see the combination that it is supposed to be, if you look at the principal element, and if you look at the return element and decide on the nature of the instrument, so we can say as far as the principal is concerned, it is irredeemable in nature. And as far as the return is concerned, it is mandatory in nature. Now, the moment you look at this combination, you would recall I've already covered this in chart number 1. I've already covered this combination in chart 1, and I gave you a discussion making an amendment to this particular combination in the previous class. And I said that if this is mandatory, it's time to compare the contracted rate versus the market rate. And when you compare the two, you're going to get two situations. The contracted rate and the market rate is same, or the contracted rate is less than the market rate. If the contracted rate and the market rate is same, then it becomes a financial liability. It's not a compound financial instruments in that case. I gave you the logic also, and I said that even if you try to calculate the equity element, it will turn out to be 0. And if the contracted rate is less than the market rate, then it certainly turns out to be a compound financial instrument. So just to give you a clarity of thought here again, we can say even in this case, the mode of payment is cash. The mode of payment is cash. And in this particular case, I don't need to decide whether it's a derivative or a non-derivative instruments, but just for your knowledge, it becomes a non-derivative contract. So we can definitely say that we've seen two examples of a non-derivative contracts becoming a compound financial instruments. One is a combination where one of the components is equity, another is FL. The illustration number 27 talks about the fact where the principal is redeemable and the return is discretionary. Then the illustration number 28, which also tells me that the principal is irredeemable, but that doesn't make a difference. The return, which is mandatory, needs to be compared with the contracted and the market rate and then take a decision. And accordingly, we decide, is it a compound financial instruments or not? I hope, friends, I am able to give you a good level of clarity on the identification part. We've already covered these permutation combinations, but we're just still having a look at them. And, we're just endorsing what we have covered so far. I hope I'm pretty clear on my permutation combinations to you, right? Okay, that's wonderful indeed. Let's now take this further. This was illustration number 28. Now let's go to the illustration number 29. Now we're coming to illustration number 29, and we've covered this as well earlier. Now it says continued from illustration 5. You can see that what we did in unit 1 in terms of just identifying is being recapped again in terms of unit number 3. Brilliant. Okay, so now we can see in illustration 29, optionally convertible, redeemable preference share. Now, when I say optionally convertible, so the word optionally convertible immediately triggers something in the mind. Option to convert gives rise to a derivative element in the instrument. Is this supposed to be a hybrid contract? And I did a discussion with you in terms of the chart number 5. So this is a case of a hybrid contract where it is a compound financial instruments and there is a derivative embedded in the instrument because the option to convert is the presence of a derivative in the instrument. Let's, I think, have a read on illustration 29. D issues a preference shares to G. The holder has the option to convert these preference shares to equity instruments. Mind it carefully. The option to convert is with the holder. Now you would, recall this very clear that I gave you the concept that the option is with the holder. Then we said we need to apply a fix for a fixed test in terms of the derivative embedded. And depending upon whether the fix for fixed test is met or it fails, accordingly, we choose to segregate the derivative or not. We covered this in chart number 5 in the previous class as well, where I gave you the concept that you need to understand that the conversion option is with the issuer or the conversion option is with the holder. So we're going to talk a little more in terms of the conversion option with the issuer today, because there is one very beautiful illustration given in the study mat, which tells us that if the option to convert is with the holder, then what we do? Sorry, issuer, then what do we do? But right now, this option to convert is with the holder. So it says D issues preference shares to G. The holder has got an option to convert those preference shares to equity instruments of the issuer at any time up to a period of 10 years. If the option is not exercised by the holder, the preference shares are redeemed at the end of 10 years. So in any case, the issuer has got an unavoidable obligation to pay cash because it's the right. It's the option which is available with the holder, whether he wants cash or whether he wants shares. But in any case, as far as the issuer is concerned, he's got an unavoidable obligation to pay in cash. Examine the nature of the financial instrument. So if I come back to my board illustration 29 to map this up. So I can say in terms of illustration 29, this is certainly a hybrid contract. And I think, let me also remind you, though there are no more inputs given in the question, but we can certainly say, which I told you in the previous class as well, that when a company issues an instrument with an option to convert, the interest rate on a non-convertible instrument is always greater as compared to the rate of interest on a convertible instrument. Because I said generally what the company would do, if you're paying a 10% coupon rate on a non-convertible instrument, you will not pay a 10% coupon rate on a convertible instrument. The company will definitely pay slightly lesser as compared to a non-convertible instrument. This will lead to, as I said, a suppression of a liability and resulting in an equity component in the instrument. So generally, I'm putting the words very clear. Generally, if there is an optionally convertible instrument, one is bound to assume that it would be a compound financial instrument. And with the element of the option present, it becomes a hybrid contract. So this contract has got, as we said earlier, a non-derivative and a derivative component. The compound financial instruments without the option is the non-derivative, which will be segregated in terms of financial liability and the equity component. And as far as the derivative is concerned, you'll have to apply a fix for a fixed test and decide that if it fails, then what do we do? And if it passes, then what do we do? And I think I've already made a mention when I gave you the chart number 5 in the previous class. I gave you very clearly that if the fix for fixed test fails, it becomes a financial liability which is to be segregated. But if it passes, it becomes equity. Then in that case, we don't need to segregate the derivative element. So in this particular case, we can say that if the fix for fixed test passes, you are going to segregate 3 components in this instrument. Sorry, if it passes, you're going to segregate 2 components in the instrument. One is the FL and the equity. But if this fails, then you'll segregate 3 elements, 3 components of this instrument: the financial liability non-derivative portion, the financial liability derivative portion, and the equity in this case. So this is also what we've already covered. So you can now very well see that in terms of compound financial instruments, we've given 3 illustrations. One, the first and the second illustration, 27, 28, was dealing with a non-derivative. And the illustration number 29 is dealing with a hybrid contract. So we've already covered all these things. There can be, of course, more instruments also, which are in the nature of compound financial instruments. Don't be under the impression that these are the only 3 permutation combinations of CFI. Well, this is just an illustrative example where they are just trying to correlate it once again that you've seen these permutation combinations, that they are compound financial instruments in nature. So I think that takes care of my agenda number 1. How do you identify that the instrument is compound financial instruments? Though we had already covered that, but this was just a little more endorsement in terms of things we have covered. Great. So I hope I am pretty clear till this particular case. Okay, I think Shobham has got a question. So only the return component is the compound financial instruments? Well, I think if you're talking in terms of illustration number 29, no, even the principal component would be considered. Okay, let me give you a chain thought further. As we're going to discuss the split accounting, I'll also make it very clear, but I think since you've raised the question, let me put this at this stage. When you're looking at the calculation of the financial liability element, when you're doing a split accounting in terms of a compound financial instruments, we are basically going to identify the unavoidable obligation to be paid in cash. Mind the words. I'm going to consider the unavoidable obligation of the issuer to pay the money in cash. So whatever is the unavoidable obligation in terms of a cash payment that gives rise to a financial liability element. So whether it is the principal element, whether it is the interest element, and this will be discounted to time value of money. We'll get more clarity as we go to the next section with you. But I hope my first section of discussion is absolutely clear. I don't see that there is any challenge in terms of identifying that whether a given instrument is a compound financial instrument or not. Right? So these 3 illustrations have further endorsed the viewpoint. I guess I'm pretty clear on that. Great. Right, Aniket, right, Manni. Okay, that's wonderful indeed. Now let me take it further. Now let's go to the second section, split accounting. And remember, here I am going to do, a little more detailing with you. because I see that many students at time are not able to catch up with the concept on the entire accounting of compound. Because so far, in the journey in the previous two classes, discussions has been quite, on a theoretical concept, not exactly theoretical, but, we've not done any accounting, I would say the traditional kind of accounting. But now in this particular case, it's important that we learn this accounting as well. So I'm going to give you a good clarity of thought in terms of accounting. So we're going to do some good number of questions with you today so that you get a complete hang in terms of compound financial instruments accounting. So let's begin the second stage, split accounting. So I am now coming to the concept of a split accounting. Now, let me make one thing very clear. When you look at a compound financial instruments, let's consider that we're talking of a non-derivative instrument for the time being. Let's consider we're looking at a non-derivative instrument for the time being and not considering the derivative for the time being. I need to segregate the financial liability and I need to segregate the equity component. And I said this previous class as well. And let me put this once again to you. When you're looking at the calculation of the financial liability element, what we need to do, we will consider the present value of unavoidable. We will consider the present value of unavoidable cash payment. So whatever is the unavoidable amount which you need to pay in cash, look at what the issuer is liable to pay in cash. It's an unavoidable cash payment. So whatever is the unavoidable cash payment which the issuer is required to make, that will give you the financial liability. So when you take the present value, the question rises, what kind of discount rate are we going to use in terms of calculating the present value? The discount rate is to be taken as the rate on non-convertible instruments. I'm putting it as NCI. That's non-convertible instrument. So the question will very clearly give you the inputs that what is the interest rate which prevails on a non-convertible instrument. So if you're given that this is the rate of interest on a non-convertible instrument, we will consider that particular rate and we will calculate the present value of all the unavoidable cash payments. So you would take the proceeds as a base. You will take the proceeds as a base, calculate the financial liability element. The balancing figure is going to be considered as equity. So the split accounting is very simple. Whatever is the amount which you have raised from the security, that becomes the proceeds. Then you segregate that this is the financial liability element, which is the present value of all unavoidable future cash payments. And the balancing figure becomes equity. Okay. Now, having said that, I think now let's start back on the split accounting. So what we are going to do in this particular case, I'm going to start with illustration 30. Now, let me tell you, how am I going to proceed in terms of the compound financial instruments? I'm going to take a total of 4 cases with you. First, I'm going to deal with a perpetual debt instrument, which is classified as a CFI. I'm going to consider a perpetual debt instrument, which is classified as a CFI 1. Then I'm going to take you to the concept of what we call, let's say, partially convertible instrument. Then I'm going to take you to the third one, that is a mandatorily convertible instrument. And then I'm going to take you to the fourth case, which is optionally convertible. So I'm going to deal my discussion on split accounting in 4 areas. One is irredeemable, one is partially convertible, one is mandatorily fully convertible, and one is a case of optionally convertible. The last one is going to be a hybrid contract. So once we're done with these 4 cases with you, you're going to get a good clarity of thought by the end of the day. So let's, I think, begin the journey with illustration 30. So let me just map this up. So I'm looking at the case number 1. So I'm putting this as case number 1. And please do try these questions by hand. After the end of the class today itself, just pick up these questions and do the things by hand. So I'm looking at the case number 1, which is illustration number 30. And this is a case of, we can say, perpetual debt instruments. So this is a case of a perpetual debt, which is a CFI. Let's read illustration 30. It says P company takes a loan from Q company for 12 lakh. The 12 lakh becomes the proceeds. The loan is perpetual and entitles the holder to a fixed interest 8%, irredeemable principal, and it's a mandatory interest. The rate of interest contracted is at the rate of 8%, and then it says the rate of interest commensurate with the credit risk profile of the issuer is 12%. So the contracted rate is 8% and the market rate is 12%. You know that this is a case of, you can say, suppression of a liability, giving rise to an equity element in the instrument. It is definitely a CFI. Calculate the value of the liability and the equity components. So let me bring you to the illustration 30 answer. Now, when I'm going to apply the split accounting, when I'm going to apply the concept of split accounting, what we'll do, we'll take the proceeds as a base. In this particular case, if you look at the proceeds are to the extent of 12 lakh. So my proceed is 12 lakh rupees, and I need to segregate that there is a financial liability element and there is an equity component, which I'll take as a balancing figure. Now, as I said, the financial liability will be the present value of unavoidable obligations. Now, I think it's time to ask you a question. In this case, when you're considering the present value of unavoidable obligations, are you going to consider the principal or just the interest? It's an irredeemable instrument. So what is the obligation of the issuer to pay? Is it the principal and the return both, or just the return? I think you can answer it very well. So in this particular case, if you're looking in terms of what is the outflow, the unavoidable obligations to pay, can I say it is just the return? The company is liable to pay that amount of interest each year by year. So in this case, we will consider that there is going to be an annual payment of how much? On 12 lakh rupees, the interest rate is 8%. So if you calculate on 12 lakh rupees, 8%, that comes to 96,000. Now this 96,000 is like an annuity which you are going to pay forever. So when you calculate a present value of annuity, the present value of annuity is taken by A by R. So that is how you calculate the present value of annuity till perpetuity. When you divide this by R, it's not the contracted rate, but it's the market rate, which is 12%. So this is the present value of the annuity paid till perpetuity. So this works out at 8 lakh rupees. So we can say that out of 12 lakh rupees, 8 lakh becomes a financial liability. So the balancing figure, that is 4 lakh rupees, becomes the equity component of the instrument. This is how the segregation of compound financial instruments in terms of FL and the equity element takes place. I guess I'm pretty clear on that. And I think we got wonderful answers on that. We just take the return. That's absolutely correct. Now, there is a little logic which, I will not be able to explain it at this stage. I'm making a little deferment of certain things because I will be giving you a good explanation in the next class on the concept of amortized cost accounting. Because I'll give you the logic in terms of, why the concept of amortized cost accounting was introduced in these standards. But I think at this stage, I would like to now say one thing very clear. Now, what we're going to do in this case, we are now going to see the accounting of this debt instruments in the form of a ledger account. And let me now clarify something. Please hear this very carefully. In this particular case, if somebody were to say that what is the interest the company is paying annually, you would say the company is annually paying interest of 96,000. Now, please hear me carefully because the figures are same. So I might be sounding a little confusing, but please hear me very carefully. If somebody were to ask me what is the amount of interest to be recorded in the P&L, If somebody were to ask me, what is the rate of interest you're going to record in the P&L, I will say it is not 12 lakhs into 8%. No. This is not the interest I'm going to record in the profit and loss account. The interest which I'm going to record is going to be 8 lakhs into 12%. So, but that comes to the same figure now. 12 lakhs into 8% is also 96,000, and 8 lakhs into 12% is also 96,000. Well, that's a pure chance. But what am I supposed to record in the P&L is not what I'm paying. I'm supposed to record in the P&L what I should pay. There are more logics which will come later. It's too early to give you more logics at this stage, but just remember, the interest which you are going to record is not the contracted rate of interest. My contracted rate of interest is not a basis of accounting. I'm putting the words very clear. I'll be able to explain this a little more detail in the next class, friends. So don't get frightened on that where is the logic. I'll be able to give you a detailed logic in the next class, but I'm just making a statement at the time being. The interest to be taken to the P&L is not what you contract. The contracted rate of interest is not the basis of recording an expense in the books. It is the interest which I'm supposed to pay. My financial liability element is 8 lakh on which I am supposed to pay a 12% interest. This will go to the P&L. So let's have a look at now the ledger account. I would prefer to make a ledger account to give you a little more clarity of thought. Now let's see how the issuer is going to make a ledger account of this irredeemable debt instrument. So let's have a look for at least 2-3 years to give you a clarity of thought. So this is the ledger account which I'm making in the books of the issuer. So this is the debt account which I'm making. This is the financial liability element. This is just the financial liability element of the instrument. So if you ask me that what is the entry which I'm going to do at the inception, look at the beautiful entry. I'm going to pass the entry bank account debit. This is 12 lakhs. I'm going to give a credit to the financial liability element, that is 8 lakh. And I'm going to give a credit to the equity element as well, and that is 4 lakhs. Wow. So that means when a company would issue an irredeemable instrument with a mandatory interest and it turns out to be a CFI, the entry is bank debit with the proceeds. The financial liability with the unavoidable obligations discounted to the time value of money. And the balancing figure is equity. So what the company is going to do in its balance sheet, the company would be reflecting in its balance sheet this 8 lakh rupees as a part of the financial liability borrowings. And this 4 lakh rupees will be represented in the balance sheet as other equity, which will enter in the statement of changes in equity as well. The company would basically take this amount, which is 4 lakh rupees, as a part of the other equity reflected in the statement of changes in other equity. So we're concentrating only on the debt ledger, the financial liability ledger. So in this case, we put the entry at time 0 by bank. And this is to the extent of 8 lakhs, only the financial liability element. Now, what we're going to do, we are going to accrue the interest on this. We're going to accrue the interest on this finance charge at the rate of 12%, not 8%. As I've already said, the profit and loss will record the expense which I had to pay, which I'm ought to pay. So we'll take 12% on this, that is 96,000. 12% on 8 lakh. Then at the end of the first year, you're going to make a payment. And the payment which you're making is on 12 lakhs at the rate of 8%, which is also incidentally 96,000. So what you're recording in the profit and loss account is what you should have paid. And what you actually paid is just an outflow. My finance charge in the books of accounts is not based on the contracted rates. The finance charge is based on what I should have paid. I hope I'm making good sense on what I am saying. Right, I think that's right, Shubham, absolutely. And you said contracted rate only relevant at the time of payment, absolutely correct. So the contracted rate is just an outflow. The interest to be recorded in the books of accounts is based on what you are supposed to pay. Why is this happening? You'll get more logics in the next class. For that, you'll have to wait a little more. I'll give you more logics on that in the next session for sure. Then I take my balance CD and this becomes 8 lakh as a balancing figure, and this ledger account continues. Trust me. Can I say year by year, the same position will appear in every year? Can I say even if you make a ledger account for the second year, third year, fourth year, fifth year, 10th year, 20th year, this is how the position is going to look like? Because every time you'll get a balance CD of 8 lakh, so you would accrue 96,000 and you're going to pay 96,000 as well. Now, it's time to show you something very interesting. At this particular stage, it is important to show you something very interesting at this particular stage. So I am now going to take you to the Schedule 3 linkage as well. I've given you the initial split accounting. I've given you the subsequent accounting, but I think it's important that I also link you to the concept of Schedule 3 as well. So let me just also link you, friends, on Schedule 3. Just give me a second. And I think let me connect you to the Schedule 3 as well. Because unless we connect you to the Schedule 3, then I think we'll not be able to get the graphs. So let me just open my Schedule 3. Okay, so let me share the screen back to you. And let's have a look at the Schedule 3. Now, let's have a look in terms of the Schedule 3 balance sheet, where we are going to consider this accounting in the balance sheet. You can see the equity and liability. So in the same example, hear me carefully because I'm about to give you something which is a very practical kind of a thing. So I want to just connect you a little more practical orientation. You can see the equity and liability, and you've got other equity. And you can see the financial liability borrowings. So what we're going to do in this particular illustration, out of the 12 lakh rupees, can I say 4 lakhs will enter other equity. 4 lakhs will enter the other equity. And 8 lakhs will enter the financial liability borrowings. Now that 4 lakh rupees will enter correspondingly. That 4 lakhs will enter correspondingly. If you look at the other equity statement, the statement of changes in equity, you can see that equity component of compound financial instruments. Now, let me tell you something extra at this stage. Please be very, very careful. Please be very, very careful in terms of what I'm about to tell you. But this is something which is going to get developed in terms of the financial instrument standard. Now, when you look at SOKI, that is the other equity element, SOKI, I would say in terms of SOKI, there are a total of 3 tabs. You heard me correct. There are basically 3 tabs. I call them as tab 1. I call this as a tab 2, and I call this as a tab 3. Okay, let me ask you, friends, how comfortable you are on the concept of SOKI, or how comfortable you are on the concept of OCI, because you've done a couple of standards. So I think let me get that inputs from you. What is your comfort zone on the concept of OCI? Does it trouble you? What is the concept in terms of SOKI? Does it trouble you? And if it troubles you, trust me, in just 1 or 2 sessions more, I will make you very clear, and they will never trouble you in life. So does the concept of SOKI and the concept of OCI really trouble you? And I think I got the answer, yes. Okay, let me see how many of more friends are facing the trouble in terms of that SOKI and OCI. You keep wondering, what is this OCI? What do you take in the OCI? When does it go to the concept of SOKI? So does it trouble you a lot, I guess? Okay, so we got just 1 yes on that. So I believe the silence is supposed to be gold. So I think rest everybody is very comfortable with the concept. I always take the silence as a deemed acceptance in life. So if you're silent on the agenda, it indicates a deemed acceptance that yes, we are very comfortable with the concept. Great. So let me, I think, still connect a lot of you, because there are many students, watching me on the YouTube as well. And I think they'll also like to get a clarity. Shobham says yes, Aniket says yes. So just know about the things, but not in detail. So nobody will give you some inputs as well. Okay, now I'm just going a little out of track on compound financial instruments, but we're still on financial instruments and giving you a connect. If you look at the statement of changes in equity, there are basically 3 tabs. Now let's first do a little discussion from the examination point of view. When you look at the tab number 1, I'm looking at the headings in terms of SOCI. If you look at the tab number 1, the tab number 1 contains the equity component of CFI. I would say the prominent item in tab number 1 is the equity component of CFI. If you look at the tab number 2, it is reserve and surplus. It is a reserve and surplus, and I would say there are a lot of elements in reserve and surplus. Like, for example, if you look at the reserve and surplus, you'll see capital reserve, security premium, other reserves, and retained earnings. So this reserve and surplus has got a lot of elements. Typically, we can say it's got a capital reserve. Typically, it has got a security premium, and it has got retained earnings prominently. You can say these 3 items. Then there is a tab number 3, which we called the OCI component. The tab number 3 is supposed to be an OCI component. So when you look at the SOCI, you should always look at the SOCI divided in terms of 3 tabs. The tab number 1 is supposed to be the equity component of compound financial instruments. The tab number 2 is the reserve and surplus, and the tab number 3 is in terms of OCI. Now, let me tell you that if you look at the tab number 3, can you see all those items like debt instruments through OCI, equity instruments through OCI, effective portion of the cash flow hedge, revaluation surplus, exchange differences, etc., etc. All these items are a part of tab 3. So starting from the debt instruments, equity instruments, everything is tab 3. So basically, you can say your SOCI is divided into 3 tabs. The standard setters had a wonderful accounting at the back of the mind. So when they were looking at the statement of changes in equity, they created a 3 tabs, I would say. The tab number 1 is the equity component of CFI. The tab number 2 is the reserve and surplus, and the tab number 3 is OCI. Now, let me, I think, connect it a little further. I'm just taking a jump now. And I'm taking you to the aspect of the income statement. I'm taking you to the concept of the income statement. Now let's have a look at this income statement. Now in this income statement, you'll see the point number 13. Look at the point number 13 in the income statement, profit or loss for the period. This is, you can say, till the point number 13, we've divided the income statement into 2 components. We've divided the income statement into 2 components. One is, you can say, the profit and loss section up to point number 13. And there is an OCI, which is point number 14. And when you add the point 13 and the point number 14, you get what we get in point number 15, total comprehensive income. So the idea was to segregate the amount of, profit and loss in 2 sections. One is in terms of the profit and loss section up to point number 13. Then there was an OCI section, and then getting the total comprehensive income. So let me just come back. So if I look at my income statement, I would say that the income statement is been divided in 2 components, like point number 13, and there is a point number 14, and then there is a point number 15. So point number 13 is like the profit and loss section of the income statement, and the point number 14 is like the OCI section. So certain incomes and expenses are taken in the PL, and certain items are taken in the OCI, and then you get the sum total of this. This is called the total comprehensive income. Now let me explain, first of all, the basic logic in terms of OCI. Now let's say in the P&L section, you got a figure of 10 lakhs. Let's say the company made a calculation of the profit and loss. The profit for the period is 10 lakh. Let's say in the OCI, you got 6 lakh. So the total comprehensive income becomes 16. Now, just in case, let me consider, let's say the company has got number of equity shares. Let's say the company has got a number of equity share to the extent of, let's say, 2 lakhs. Would you like to give me the basic earning per share of the company? Would you like to give me what is the basic earning per share of this company? So you've given the data. And would you like to give me the basic EPS, because you've already done the basic EPS in this 33. So give me what is the basic EPS of this company. 10 lakh is the profit in the point number 13, the P&L section. 6 lakh is the profit in the OCI section, and I get a total comprehensive income of 16 lakh. So what would be my basic earning per share in this particular case? I think let's get that from you. Just look at the figures carefully. You've got this as the P&L section. This is the other comprehensive income section, and you get a total comprehensive income. Considering the company has got a total of 2 lakh ordinary shares, then what is the basic earning per share of the company? Okay, I think I'm getting the answer 8. And let's see what more answers can we get. So let's wait for your answer. I'm very keenly interested in understanding your basic EPS for this company. So when you go to calculate the basic EPS of this company, what is the basic EPS? 16 by 2, or is it going to be something else in this case? I'm getting the answers 8, 8, 8, 8, 8. And I think Shobham corrected the answer, so it's 5. You're absolutely correct. The answer is 5. The answer is 5. Now, let me illustrate this to you. The answer you rightly said is 5. It is going to be 10 lakhs divided by 2 lakh. The EPS of the company is going to be 5. Many students, many people, sometimes do that mistake in terms of calculating the basic EPS. Now, remember the golden rules. What enters, please hear this very carefully, what enters the profit and loss section, point 13, affects the profits of the company. What enters the OCI, point 14, affects the profits of the company. At the end of the day, whether it is taken in the profit and loss section or whether it is taken in the OCI section, it is definitely going to impact the profits of the company. So when you get the total comprehensive income, what went into the P&L section is a part of the total profit or loss. What enters in the OCI section is a part of the profit or loss. But what is the difference in terms of the P&L and the OCI section? What enters in the P&L section affects the EPS. What enters in the OCI section does not affect the EPS. So you can say one of the initial thought processes of the standard setters was that we need to make a distinction between those incomes and expense which should affect the EPS. Take them to the P&L section. And those items of income and expense which is not to affect the EPS, take them in the OCI section. So we can say that when you are putting things in the OCI, definitely they are impacting the profits of the company, but they're not impacting the earning per share of the company. Now, if I connect it back to the SOKI, what I would do in this example, when I say that there is a total comprehensive income earned by the company that is supposed to be 16 lakhs in my example, I would say that 10 lakh, which is in the profit and loss section, will be taken in the retained earnings tab number 2. The 10 lakh rupees will be taken in the tab number 2, and that 6 lakh, which relates to the OCI, will be taken in the tab number 3. This amount of 10 lakh is something which is available for distribution of dividends and has affected the EPS of the company. And this 6 lakh rupees is not available for dividends, and it is not affecting the EPS as well, right? I guess I'm making good sense. What you enter in the point number 13 in the P&L section enters in the tab 2 RE. And what is taken in the OCI section is entered in the tab 3. So when you make a income statement of a company. And when you make the income statement of the company, the portion which enters in the profit and loss section goes in the tab number 2, retained earnings. What you enter in the OCI section in the income statement is taken to the tab number 3 in the OCI section. And now let me also add something further. Can I say what enters in tab number 3 one day will go to tab 2? Whatever enters in the tab number 3 one day will go to the tab number 2. We'll discuss that later. Because there are two concepts, one is a recycling and one is a no recycling. So we'll discuss that. But whatever enters tab number 3, one day it'll go to tab 2. And what enters the tab number 1 will also one day go to the tab number 2. Whatever you have taken in tab number 1 today, equity component of CFI, that will one day enter the tab 2. What you've taken in the tab 3 today, one day it'll go to tab 2. So tab 2 is like, the main centric point where everything is being temporarily parked in tab 1 or certain things are being temporarily parked in tab 3. Mind the words carefully. You're parking a few things in tab number 1 temporarily. You're parking a few things in tab number 3 temporarily. Then one fine day, what is that day that we'll discuss later, but what enters the tab number 1 will go to the tab number 2. What enters the tab number 3 will ultimately go to tab 2. Because it's tab 3 and tab 1 is like a temporary parking space. So the standard setters had one thing very clear in mind, that they wanted to create a particular section of the income statement which should not impact the EPS, and that's called OCI. They wanted to create a section in the income statement which will not affect the EPS, and that's called OCI, which enters the tab number 3 of SOKI. But one fine day, that items in tab 3 will enter the tab number 2. So you can say what enters in the OCI today doesn't affect the EPS of the company today. And what enters in the tab number 3 from there is not available for distribution of dividends as well. So the company's profit and loss section gives you a figure which affects the profits, which affects the EPS, and it is available for dividend distribution today. What enters in the OCI affects the profits, but it doesn't affect the EPS, and it is not available for dividends right away. I guess I made complete sense on that. Are you able to catch up with the concept, I guess, friends? I guess you're able to catch up with the concept well on this. So let me just make a little note at this stage so you are able to get it very clear. So moral of the story. We were just a little out of this standard, but just to connect you in terms of schedule 3. So we can say that when you record in the profit and loss section and when you record in the OCI section, let's get the chain very clear. Let's get the chain very clear. That when you record in the profit and loss section, can I say this is impacting the profits? Does it impact the profit or loss of the current year? Yes, it does. Does it impact the EPS of the company? Does it impact the EPS of the company? Yes, it does. Is it available for dividend distributions by the company? Yes, it does. It's available for dividend distribution as well. So what the company takes in the profit and loss section, and to tell you, this is taken where it is taken to SOKI. It is taken to SOKI in terms of the tab number 2, specifically in the column RE. So when the company earns something and takes it to the profit and loss section, it enters the tab number 2, retained earnings column, and then it impacts the profits of the year, it impacts the EPS for the year, it also is available for dividend distribution. But when you look at the OCI, this is also taken to SOKI, but this is taken to the tab number 3 of SOKI. This is taken to the tab number 3 of SOKI, and typically it could relate to any column. I mean, it depends upon the nature of the item, where it is going to be taken, but definitely to the tab number 3. Does it impact the profits of the company? Yes, it does. Does it impact the current year EPS? No, it does not. Is it available for distribution of dividends as of now? No, it is not. So this was the thought processes of the standard setters. So when you look at any standard and you are, studying the aspect that this is to be taken to the OCI, you can relate. Why is it going to OCI? Because the standard setters didn't want that it should impact the EPS of the company. They didn't want that it's available for dividend distribution. But once this amount gets transferred to tab number 2, once it gets transferred to tab number 2, at that stage, it will be available for dividend distribution. It will be available for dividend distributions at that particular stage. So this is a very important chart which I've given you, which is going to give you a little clarity in terms of the connection of a P&L OCI section vis-a-vis the SOKI statement. That what is entered in the P&L section impacts the profits, impacts the EPS, and is available for dividend distributions. But what is taken in the OCI impacts the profits of the company, but has got no impact on the EPS for the current year. It doesn't impact any dividend distribution availability. But what enters the tab number 3 one fine day will definitely get transferred in terms of the tab number 2. And then it becomes available for dividend distributions at that stage. Right, so that was a little off-track thoughts, but I guess I am pretty clear on this particular concept. Okay. Now let me just come back to my compound financial instruments discussions with you. So having explained this connect, so I am back to this particular case where it was a perpetual debt instruments. So now the question comes to the mind. Can I say in this particular example, that 4 lakh rupees enters, you can say the tab number 1 of SOKI. Now what happens to that 4 lakh rupees? What are you going to do with that 4 lakh rupees? Can I say this is an irredeemable debt instruments? So since it's an irredeemable debt instruments, that 4 lakh rupees is going to rest in that tab number 1 only. Because we are not going to convert this, so it's going to rest in the tab number 1. And we'll see in other cases what happens to the equity component. But this 4 lakh rupees will continue to be the same year by year. If the company is issued an irredeemable debt instrument, that 4 lakh rupees remains intact. And it is intact in the form of that other equity, or we can say the tab number 1 of the SOKI. Right, friends. So I think this was my case number 1 to give you. And the clear Manani, clear Rashmi, wonderful indeed. Now let's go to the next one. This was illustration 30. This was case 1, illustration number 30. Let me now come to the next illustration with you. Let me just come back to the study mat. So back to the unit number 3, illustration 30 is done. And now let's have a look at, no, not illustration 31 right now. I'm going to show you a question now, which I'm carrying with me. And in this particular case, I guess, let me connect you to one of the examination questions which came in November 2019. Don't worry, I'll share that question also with you. This is an examination question which came in November 2019. This is dealing with the concept of what you call partially convertible instrument. Let me read this now. It says Vedika issued 80,000 8% convertible debentures of 100 each on 1st April 15. The debentures are due for redemption on 31st March 19, which means 4 years later, at a premium of 20% convertible into equity shares to the extent of 50% and the balance to be settled in cash to the debenture holder. Now, in this particular case, we are very clearly given that these debentures are due for redemption at a 20% premium, number 1. And it is to be converted into equity shares, 50%, and the balance to be paid in cash. It's a partially convertible instrument. The interest rate on a debenture without conversion is 12%. So we can very clearly see that when it involves a conversion, the company is paying an 8% interest. But if it is an instrument without any conversion, then the interest rate is 12%. The conversion to equity qualifies as fixed for fixed. So in this particular case, he's already said that if it qualifies for fixed, that means we can conveniently say that in this particular case, the element of the derivative, the option is supposed to be equity. There is no need to segregate the equity component of the derivative. Because when you qualify for the fixed for fixed test, we've already said that there is no need to segregate the derivative embedded in the instrument. You are required to separate the debt equity components at the time of issue and show the accounting in the books at initial recognition only. But I think I'd like to show you the accounting 1 or 2 years also, though it's a total period of 4 years. And we're given the discounting rates at 8% and 12% for the factors. Okay, let's, I think, look at this November 19 question and let us solve this November 19. Let's first of all do the split accounting, what we're going to do at time 0. Now, first of all, what I'm going to do, I'm going to consider the proceeds. First of all, I need to consider the proceeds at this stage. So what is my proceeds in this particular case? The company issued 80,000 debenture and the face value is 100 each. So we can say 80,000 debentures of 100 each. This is coming to a total of, I guess, 80 lakhs. So we can say the proceeds in this case is 80 lakh. Now we need to segregate the financial liability and the equity component. And I think, let me ask you this particular question. When you go to segregate the financial liability element, are you going to consider the entire principal and the entire return, or just the 50% principal, which is supposed to be paid in terms of cash? Look at the question. The debentures are due for redemption 4 years later at a 20% premium, convertible into equity shares to the extent of 50%. The conversion is already meeting a fixed for a fixed test. That means we are going to issue a fixed number of shares for a fixed consideration. So in this particular case, can I say my unavoidable obligation to pay cash is restricted to the extent of 50% of the principal. And of course, I'm going to pay that 8% interest for the next 4 years, right? So we're going to consider in this particular case, the unavoidable obligation is, we can say 80 lakhs is to be paid at a 20% premium. You got to pay the redemption money at a 20% premium, but I'm considering only 50% of this because we've got a 50% conversion and 50% payable in cash. So that 96 lakhs, 20% premium, 50% of this, that is 48 lakhs is to be discounted. This is what is going to be paid after a period of 4 years. So we are using the discounting rate of 12%. So 12%, the factor is 0.625. So this money is going to be paid at the end of the 4th year. And apart from this, there is also an obligation to pay the interest on that 80 lakh rupees, which is going to be paid at the contracted rate of 8%, which is going to be paid for the next 4 years. So let's take the cumulative factor. At 12%, 0.887, 0.788, 0.701, 0.625, that's 3.001. So what I've done, I've taken the unavoidable payments in cash to the extent of 50% of the principal money with a 20% premium on redemption and the annual interest which is paid at the rate of 8%. So let's see what is the liability component. The equity component can be comfortably taken as a balancing figure. So this is 96 lakh into 50%, 48 lakhs into 0.625, that comes to 30 lakhs. Then 80 lakhs, 8% into 3.001. So I think this is working out to approximately, you can say 49.2064 lakhs. So we're getting a figure of 49.2064. So 80 minus 49.2064, the balancing figure is supposed to be 30.7936. I hope my calculations are correct on that. So this gives me the balancing figure, which is the equity element. And that's right, Manani, absolutely correct. So we get the proceeds of 80 lakh segregated in terms of the financial liability and the equity element. So if I were to look at a journal entry, which I'm going to pass at initial recognition, can I say the entry is bank account debit? This is with the proceeds that is 80 lakhs, and we'll give a corresponding credit to the financial liability element that is 49.2064 lakhs. And we will give a credit to the equity component as well, and that is the balancing figure that is 30.7936 lakh. Now, though the requirement of the question ends out here, because he's asking me to do the initial recognition entry, but I want to understand a little further. So I want to understand how the ledger account of this financial liability element will be drafted, how the equity element is going to get taken care. So I think, to give you a clarity, what do you want? You want me to make a ledger account for all the 4 years and give you the movements in terms of the SOKI as well? And it's a choice. I know, the dil mange mo. So you want me to make a ledger account for all the 4 years movements and also reflect the SOKI movement as well, to give you a little more clarity of thoughts. So I think what we can do, we can give a kick start off on this. Let's make the ledger account for a period of 4 years in this case. So let's make a ledger account which is for a period of 4 years. Let me kickstart this and make it for the first year at least. Then I think maybe we can give you a break after that, and then you could try the ledger account for the next 3 years to come, and I could give you a SOKI presentation as well. Okay, I think I am getting answer from Sai Venkat. You said 80 lakhs into 8% is 192640. That's rightly said. Thanks for the input. So let's make the financial liability element. So we record by bank, and this figure will be taken from the liability element 49.2064. This is 49.2064 lakhs. So would you like to tell me what is the finance charge you're going to record at the end of the first year? Of course, not what you pay, but what you ought to pay. So at the rate of 12%. So on 49.2064, we take a 12% interest. That's approximately 5.9048. 5.9048. And then you make a payment to bank. And this payment which you're going to make is going to be equal to that figure which you raised. 80 lakh was the proceeds, and we're making an 8% contracted rate that comes to 6.4 lakhs. So we get a balance CD as a balancing figure, and this will continue. So this is going to be 49.2064 plus 5.9048 minus 6.4. That works out at 48.7112. Now, the same position will continue for the next 4 years to come as well. We're going to make the ledger account for the next 4 years also on the same lines. So I think if we can give you that little mathematics to do in between the break as well. So I think what I'm going to do now, I'm going to give you a break so that you can help me with the calculations. I'm being a little bad on that. So that you can do the workings and get ready for the calculations on this, right? And then I'll take this ledger for the next 3 years as well and give you what is the position which will stand in the SOKI as well. So I think on that ground, I think let's first give you a break, I guess, friends. And we're just going to take a 10-12 minutes break now, and then we'll commence back with you. So enjoy a break, but do the calculations in between as well. I'll join you after the break in 10 to 12 minutes time. Welcome back, friends. So I guess you've done the calculations for me as far as the financial liability element is concerned. So I'll take the figures from your end and pick them up. So I think I've already got the interest from Saksham. So let me just take the calculations for the view. This was the ledger account which we made for the first year. I think let's make this for the second year as well. So the balance CD is going to become the balance BD in the next year. That's 48.7112. Then again, you consider the finance charge on this outstanding balance, which is going to be taken at the rate of 12%. So let me get the figures at your end. Oh no, that was the previous figure, I guess. So let's have a look at the finance charge at the rate of 12% on this. So 48.7112 at the rate of 12% would mean 5.845 approximately. And then we make the payment based on the contracted rate of interest, which is 6.4 lakhs. And we get the balance CD as a balancing figure. So 48.7112 plus 5.845 minus 6.4, that works out at 48.1562. That becomes the balance BD in the next year, and the journey would continue. Let me ask you something. Can I say once I make the ledger account for the next 2 years, do you think this ledger balance will have any balance left over, or will it become zero? Since we're considering that in this particular case, we're going to make a 50% payment in cash, and this liability ledger is reflecting the payment of that cash component and the interest component. So do you think any balance will be left over after the 4th year ledger account is made? Well, of course not. You'll not be left with any balance which will be left over at the end of the 4th year. So basically, your financial liability balance will become zero at the end of 4th year. Then what happens to that equity element? What happens to that equity component which we segregated at the start? That is 30.7936. Okay, I think let me elaborate on that particular part. Can I say at the end of 4th year, when the holder would convert this into equity shares, you would put the entry that equity component will be given a debit, and correspondingly we'll give a credit to the equity share capital depending upon the number of shares which have been issued, and we will also give a corresponding credit to the security premium to the extent of the premium, if any. So whatever is the balance, that is 30.7936. The 30.7936 will be split in terms of the equity element, equity share capital, which is to the extent of face value of the equity shares, and any excess received will become the security premium, which will be taken to the security premium balance. So can I indirectly say that this element which was taken to the tab number 2, remember we were talking, tab number 1, this equity element which was earlier taken to the tab number 1 of SOKI gets partially transferred to the tab number 2 in the form of security premium. It's not the entire amount which is getting transferred to the tab number 2, but you can say to the extent of face value, it got converted to equity share, and to the extent of premium, it enters the tab number 2. So if you technically look at the movement in terms of, let's say, the balance sheet, we've got the equity in the balance sheet, and we've got equity share capital, and we've got other equity in the balance sheet. So if I were to look at the movements of this particular component, I would say that out of this 30.7936, out of that 30.7936, what we can say that some portion gets transferred to the equity share capital, and some portion still remains within the other equity. The face value component will enter the equity share capital, and you can say the other component is shifting within equity. It is shifting from tab 1 to tab 2. The element of security premium gets shifted from tab number 1 to tab 2. So one portion of the tab 1 gets converted to equity share capital at the end of 4th year, and another component, which is supposed to be the security premium, is going to get translated from tab number 1 and in tab number 2. I hope I made myself very clear on the movements in terms of this equity component, which is going to take place at the end of the 4th year, right? I guess I'm pretty clear on that. Okay, so I think this is done. So this was my second case wherein I have taken the concept of a partially convertible instrument, wherein we segregated the debt equity elements and we saw that what is the treatment of the financial liability element during a period of 4 years, and then what is the treatment of this equity component at the end of 4th year. Now let's take you to the case number 3, wherein we're going to talk in terms of, let's say, a compulsorily convertible instrument. So let me share another question with you. And I am sharing another question with you, which is a question which came in MTP in mock test paper, and that's came in October 21. It also came in MTP October 2019 as well. So I think let's have a look at this question number 47 on the screen. It says ABC company issued 10,000 CCPS, that is compulsory cumulative convertible preference share, on 1st April X1 at the rate of 150 each. The rate of dividend is 10% every year, and the preference shares are convertible into 5,000 equity shares at the end of 5th year from the date of allotment. When the CCPS are issued, the prevailing interest rate on a debt without conversion is 15%. So the company is issuing an instrument with a conversion option at 10%, whereas an instrument on a non-conversion is at the rate of 15%. But there is something new which is coming in this particular case. I'm also given that there is a transaction cost on the rate of issuance, which is 2%. Well, this is a new element for which I'm doing this question, that along with the fact that there is an accounting for a compound financial instrument, we're also given a transaction cost. Now, what is a transaction cost? When you're going to issue a particular security, there will also be some kind of a brokerage or some kind of a commission which you might have given to the agent in terms of organizing the funds. So there is a transaction cost which is incurred at time 0 in order to organize those funds. So the standard has given us a very typical treatment of this particular transaction cost. I'll explain as I come to you. So I am given the date of allotment is 1st April X1. The conversion is after 5 years. The number is 10,000 and the face value is 150 each. The total proceeds at time 0 is 15 lakhs. The rate of dividend is 10% and the market rate for a similar instrument is 15%. We've got a 2% transaction cost, which is 30,000. And we're given the number of equity shares to be issued post-conversion is 5,000 and it's 10 rupees each. We are required to show the accounting for the entire term of the arrangement. Now, this is a comprehensive question, and I think I'll go step by step on this particular case. Okay, Aniket said, can we get this question in the PDF? Yes, I'll share that to you. No worry. I'll be sharing that on the dashboard to you, so you'll get that question today, not an issue. So I am now doing my case number 3. Now watch this very carefully, because this question is more devoted on the treatment of TC, what I call the transaction cost. So in this particular case, I'm looking at a compulsory convertible, rather CCPS, that is cumulative compulsory convertible preference share. It could be a case of CCD as well, compulsory convertible debenture or compulsory convertible preference share, whatever. So let's, at the first instance, do a split accounting. So let's, I think, at the first instance, do the split accounting. We'll consider the proceeds of that instrument. And the proceeds of this instrument is given to me, it is 15 lakhs. We need to segregate the financial liability element and we need to take the equity as a balancing figure. Now, the question comes to the mind. When I'm looking at the calculation of the financial liability, we need to consider the present value of all the unavoidable obligations in cash. So am I considering the principal, or am I considering the principal and interest both, or just the interest? Remember, in this case, if you're looking at the unavoidable obligations to pay cash, it is a compulsory convertible preference share. So the principal amount is going to be issued a total of 5,000 equity share. So my financial liability element is supposed to be, can I say, in terms of the contractual obligations to pay the cash. So my unavoidable obligations to pay cash is restricted only to the extent of the 10% dividend. So when I'm going to measure the financial liability element, we're going to consider only the return element and not the principal element. So we're going to consider, in this case, on 15 lakhs, we're going to pay a 10% dividend every year. So let's consider what is the discounting factor. So we need the discounting at 15% 5 years. So let's take the discounting factor 1 divided by 1.15. And you need to do this 5 times and get the cumulative factor. This is 3.352. So this is 3.352. So the obligation is in terms of the return, just the dividends for the next 5 years. So 1,50,000 into 3.352, this comes to 502,800. So very conveniently, we can get the balancing figure, that is the equity component. So 15 lakhs minus this, it comes to 997,200 is the equity element. Now comes a little interesting agenda. Now hear me very carefully, friends, on this particular part, which I'm about to tell you. And okay, Sai, you said we'll take the principal and interest. Just the interest, not the principal. Since the obligation to pay cash is in terms of equity shares, we're considering only the interest element in this case. Okay. Now comes a little interesting agenda. So be a little careful on what I'm about to do. Now, the company has incurred a transaction cost of 2%, and that 2% is given to me is 30,000 in absolute figures. Now the question rises that this 30,000 is relating to both the financial liability and it is relating to equity. So the standard tells us a very interesting treatment. This 30,000 is going to be split between the financial liability and the equity element in the same ratio in which the split accounting is done. I repeat, when a company has incurred a transaction cost related to a compound financial instrument, this 30,000 is to be split between the FL element and the equity element in the same ratio which we have computed in the split accounting. And then we'll see further. So let's split this transaction cost between the financial liability and the equity element in the same ratio, that is 502,800 is to 997,200. So we divide this in the given ratio. So 30,000 into 502,800. 30,000 into 502,800 divided by 15 lakhs total. This is coming to 10056. And the remaining relates to the equity component, that is 19,944. Now the question rises, after making a split of this element, what do we do with these two elements? Now, as far as the amount of transaction cost relating to the financial liability element is concerned, this is going to be reduced from the financial liability amount. So the financial liability amount which we have taken above was 502,800. And we're going to reduce this amount because in order to organize this particular amount, we had to incur a transaction cost of 10056. So you can say the net proceeds arranged is going to be the difference. So 502,800 minus 10056, we get the figure that is 492,744. So whatever is the transaction cost which relates to the financial liability element, that is going to be netted against the financial liability figure. But whatever amount relates to the equity component is going to be directly taken in. It's going to be directly taken and charged to the SOKI itself. So whatever transaction cost the company has incurred, which relates to the equity component of the CFI, is going to be directly charged in the SOKI. It's not going to be taken to the P&L account. It's going to be directly adjusted in the statement of changes in equity itself. Only the financial liability element gets reduced from the amount of the FL. Now there is a big thing to be done. When you did this concept of calculating the financial liability, you took the present value at 15%. Now, I'm going to say a slightly technical thing. Just hear me very carefully on what I'm about to say, because you must have done this concept earlier in different standards as well. Let me say something, vouch me friends on that. Can I say, if you carefully look at the ledger movements, what are you technically doing? Can I say you first of all took the present value of the future payments, and then did you start unwinding of the discount? I repeat, if you look at the concept of calculating the financial liability and making the ledger account of the financial liability, am I indirectly doing what? I'm first of all calculating the present value. I'm doing a discounting of the future payments. And then after doing the discounting of the future payments, am I indirectly doing the unwinding of discount? That you're attributing the finance charge in the ledger account, is it not indirectly unwinding the same discounting which is done? What do you say? Am I making sense on that? That when I am looking at the concept of a financial liability, you said, okay, these are the future payments. So let me calculate the present value of all those future payments. It was discounting. And then in the ledger account, what you did, are you indirectly doing an unwinding of discount? I guess you agree with what I said. Now the question arises that when you did the discounting in this case was done at the rate of 15%. The discounting was done at the rate of 15%. Then you netted off the TC from this figure. Do you think I'll be able to do the unwinding at the rate of 15% itself? Sir, can you put that once again? I think let me now concentrate on what I have been doing in the ledger accounts on a mathematical front. When you considered the calculations of financial liability, you said, okay, these are the future payments. Let's discount these payments at 15%, and you took the present value. That was technically discounting. Then in the ledger account, what you started doing the unwinding, and you started calculating the interest at that rate. So first you did the discounting, and then you did the unwinding of discounting in the ledger. But since in this case, there is a transaction cost which is involved, the problem is that when you did the discounting, it was done at 15%, and you got the figure 502,800. Now, since you've netted the transaction cost from that figure, if you do the compounding or the unwinding at 15%, you'll never reach the figure of 50200. Am I making complete sense? That in this case, the rate at which the discounting took place and the rate at which the compounding is going to take place cannot be the same, only because of the presence of a transaction cost in the question. Right? Wonderful. Okay, Shom, you said, can we make a comprehensive chart of the final three-step model? Okay, I'll do that. In terms of the compound financial instruments also today, I'm going to give you a final chart in the end in terms of all the permutation combinations, that if it is a suppose of irredeemable debt, if it is a partially convertible, if it is mandatorily convertible, or if it is optionally convertible, then which place do you do what? Which particular case in financial liability elements you take the principal, which element you take just the interest, or you take partially the principal, all that will be done. Okay, now coming back to the agenda. So whenever in a question on a compound financial instruments, you are given a TC, what you need to do in terms of TC, first you need to split that transaction cost between the equity element and the financial liability element. The TC which relates to the equity component will be directly taken to the statement of changes in equity. But the transaction cost relating to the financial liability element will be adjusted against the carrying value of the financial liability. You'll basically net of the two. Now, the moment you net of the two, you need to be careful that now you cannot unwind the discount using that same 15% rate of interest. So there will be a need to recompute, you can say, the discounting rate for this purpose. And for this particular purpose, you'll have to calculate what we technically call the EIR, or what we call the internal rate of return. So I don't know if you've been exposed to the concept of internal rate of returns in the earlier standards or not. Maybe yes. I guess you're aware of the concept of how do you calculate the effective interest rate? Yes, of course, you've done it in financial management, even at the inter level. So what we're going to do in this particular case, we will interpolate and calculate the new discounting rate, which can be used for the purpose of leisure. You want me to show you the calculations of the new rate, or do you want me to pick it directly? Because this question, came quite recently in one of the RTPs, or I think it was there, and the new effective rate of interest was directly given in the question. So if you want, I can show you the calculations, though that's a financial management element, or if you're comfortable, I can directly take the figures itself. So you want me to show the figures? Okay, I think, Soham, you said, sir, no, sir, amortization schedule is disturbed. That's right, absolutely. So, and I think, Shobham, you said, can we adjust the rate by taking into effect the account of TC? Of course, yes. I think, let me show that to you. Can I say, if I'm wanting to calculate the effective interest rate in this case, let me first ask you something. When you calculate the effective interest rate, we always do this from the investor's point of view. The calculations are always seen from the investor's point of view. So from the investor's point of view, can I say he made an investment, and that's going to be a figure of 492,744. And if you look at the inflows in this case is that he's getting a 10% dividend every year for the next 5 years. So he's getting that 1,50,000 dividends, which is an inflow for the next 5 years. That's the only inflow he's getting. So earlier, when we were given a 15% discounting rate, it was based on the outflow of 502,800. So the outflows have now gone down. If the outflows have gone down, then we can say the effective rate of interest will slightly go above 15%. So we'll take a hit in trial, and let's do one thing. Let's calculate the NPV at 15%, and let's calculate the NPV at 16%. So from the investor's point of view, you can calculate the NPV at 15 and 16% so that we will get a range where at 15% we're going to get a positive NPV, and at 16% a negative NPV, which would indicate that the effective rate of interest, the internal rate of return is definitely between 15 to 16%. So from the investor's point of view, let's take the present value of cash inflow, and then we can take the present value of cash outflows, and we can get the NPV and then interpolation. So if we look at the inflows, we know the inflows is 1,50,000. This is for the period of 5 years, where the PV factor is 3.352, and the outflow is 492,744. And I think even if you compute, we know this, that the NPV at 15% is going to be equal to the TC, that is 10056. I'm not even computing this. I know this mathematically, that the NPV at 15% is going to be equal to the TC. So let's take the factor at 16%. And at 16%, 1.16, 5 times, twice, 3, 4, and 5. So this is, I think, 3.274. And the outflow remains the same, that is 492,744. So we can get the NPV, and hopefully we should get a negative NPV this time. Yes, we are getting a negative NPV, and that's 1644 negative, which I think indirectly proves that my internal rate of return is certainly between 15 to 16%. I can apply the interpolation or the unitary method and get my effective rate. So this is going to be 15% plus We take the NPV at 15% divided by the differences in the NPV. So differences in NPV and the gap of the range is 1%. So this will give us the effective interest rate. So 10056 and 1644, 11700. This is coming to approximately 15.86% is the effective interest rate. So this is one additional exercise you'll have to do every time there is a transaction cost which is given in the question. So if you're given a transaction cost in the question, we'll have to reorganize the internal rate of return because the TC gets adjusted from the liability figure. So there will be a need to recompute the rate at which the unwinding requires to be done, right? I guess this financial management part is pretty clear. Okay, now we are in a position to make the ledger account. So let's make a ledger account for the financial liability element. So let me just make a ledger account for 1 or 2 years as far as the financial liability element is concerned. Then we'll discuss about the equity component as well. So we record this figure that is by bank. And when you record this figure, remember this is the net figure, which is net of TC. We need to record the financial liability net of TC, which is 492,744. This is 492,744. And then we unwind the discount in this case in the form of finance charge at what rate? The new effective rate, which is 15.86%. So we'll unwind the discounting at the new rate identified. So 492,744 into 15.86, that's 78,149. And then we make the payment for the contracted rate, and the payment for the contracted rate is 1,50,000. You paid a 10% dividend on 15 lakhs, that's the contracted outflow. We get the balance CD as a balancing figure, and this is how the ledger account will be done. So 492,744 plus 78,149 minus 1,50,000, that works out at 420,893. So this is how the ledger account will be prepared, and you could alternatively make an amortization chart as well. Many people prefer to make an amortization chart. I slightly prefer to make a ledger account because it's very easy, to understand the movements in the form of a ledger account. But alternatively, if you want to make an amortization chart as well, you can absolutely do that. So this becomes a balance BD in the next year, and then you would accordingly do the unwinding again at 15.86. So can I say by the end of the 5th year, this balance will turn out to be zero, because all the financial liability elements in the form of interest payments will get taken care, and the ledger account will become zero at the end of 5th year. Now I want to understand the movement of that SOKI. I want to understand that element of 997,200, which you took in the equity component, what happens to that at the end of 5th year? So let's have a look. Can I say at the end of the 5th year, this equity component that is 997,200, can I say will be equity shares will be allotted against it, and the excess will be taken to the security premium? So in this particular case, we know that as far as the number of equity shares are concerned, we will be issuing 5,000 equity shares of 10 each. So this will be 5,000 shares of 10 rupees, and the balancing figure will be taken in terms of security premium. Wow. Which means what? Can I say in this particular case, you can say that this figure which is there in tab number 1 of SOKI, can I say is getting transferred to the equity share capital, and a little portion is getting transferred to the tab number 2 in the head security premium. So the movement in terms of partially convertible instrument and the movement in terms of compulsory convertible instrument is same. The portion which is there in tab number 1 partially gets converted to equity share, and partially it gets converted into security premium, which enters the tab number 2. So not everything in tab 1 will enter the tab 2. So earlier, as I said, that what goes in the tab number 1 goes to the tab number 2, I would like to rectify and amend and say that the portion which stands in the tab number 1 can get transferred to the equity share capital, and the remaining difference on the conversion will get transferred to the tab 2 in the form of security premium. Right? I hope I have made myself very clear on the 3 cases covered so far. I think now it's time to do a little consolidation before we go to the case number 4, because that could be slightly technical in nature. So let me, I think, just give you the inputs or not. Okay, it's coming nil till the end of 5th year, Shobham. That's wonderful indeed. I think Saksham, everybody has tried that well. Wonderful indeed. So I think now at this particular stage, let me do a little consolidation of things before I take it forward. So we get a complete clarity of thought. So let's, I think, make an interesting chart at this stage. Now, when I am looking at the compound financial instruments, when I'm looking at a compound financial instruments, we've seen a variety of compound financial instruments since morning. And one of the varieties we've seen is a perpetual debt instrument. That is one. I would advise you to copy this as well. So one of the types of compound financial instruments we've seen is a perpetual debt instrument, which is non-derivative in nature. The second kind of instrument I showed you is supposed to be a partially convertible instrument. It's a partially convertible instrument, which I showed you. That was the examination question. And then I have showed you a compulsory convertible instrument as well. I'm yet to show you an optionally convertible instrument. So we yet to cover the concept of optionally convertible instrument, which is going to be a non-derivative with a derivative embedded. We yet to see that. So we can say in terms of compulsory convertible, I would call this as a non-derivative. And if it is partially convertible, let's say it's mandatorily partially convertible, then you can call it as a non-derivative as well. So we can say that we've got a perpetual debt instrument, that is one, a partially convertible, let's say 50% mandatorily convertible, then there is compulsory convertible and optionally convertible. Now, when you look at the split accounting, and when you consider the financial liability element, let's get this clear. If it is a perpetual debt instrument, do we take the principal and the return element in the calculation of financial liability? No. In a perpetual debt instruments, we don't take the principal, we just take the return. Because there is an unavoidable obligation to pay only the dividend or the interest element. In terms of partially convertible instrument, did we take the principal? We took only 50%. Which is going to be paid in cash. So this is the component which you're going to pay in cash. So let's say if it is 60% convertible to ordinary share, then you would consider 40% which is payable in terms of cash. So we are taking the principal element only to the extent it is payable in cash. We are taking the return element as well. In a compulsory convertible instruments, there is no obligation to pay the principal in cash. So we're taking only the return element. I hope you're getting the picture very clear. That when you are calculating the financial liability element, your mind needs to be very clear that in which particular instrument, what elements are to be taken. So if it is irredeemable, just the return. If it is compulsorily convertible, just the return. And in terms of partially convertible, the portion of the principal which is going to be paid in cash and the return. Now, let me ask you about an optionally convertible instrument. Let's say where the option is with the holder. Let's say if the option is with the holder, I'm not talking of option with the issuer at the moment. If the option is with the holder, do you think I'm going to consider a principal? The holder will tell me that, boss, I want cash. The holder will tell me, boss, I want equity share. So is the issuer got an unavoidable obligation to pay cash? Yes. So I'm going to consider the principal element as well, and I'm going to consider the return element as well. So be very careful when you calculate the financial liability element of the compound financial instrument. You need to consider the element which is unavoidable obligations to pay. So in this particular case, which cases are you going to consider the principal, or which cases are you going to consider the return? I guess this is one important aspect to be taken care of. You need to be very careful in terms of what you need to pick up in the financial liability calculations, I believe. Okay, I think this is done, and that's right, Sai, absolutely correct. Now, let's go to the next issue. The second agenda is that there is an equity component which is segregated. So once you segregate the equity component, the question arises, what happens to that on redemption? What happens to that when the conversion takes place? What happens to that? In an irredeemable instrument, can I say it continues to be in tab 1? It's put into the tab 1 and it will remain intact in terms of tab 1. Now, if you look at the second case, which is partially convertible, can I say this will get translated, can I say in terms of equity share capital partially? And it'll get translated to tab number 2 in terms of security premium. Am I right? Get this clear. The treatment of the equity component, as far as the financial liability element is concerned, you would make a ledger account or you would create an amortization chart and gets the movement. But in terms of the equity component, you can say in terms of the equity component, which has been taken to the tab 1. So on the conversion, a portion will go to the equity share capital and the portion will go to the tab 2 security premium. Same happens with a compulsory convertible instrument as well, that the money which has been kept in the tab number 1 on the conversion will get translated into equity share capital and a portion will go to the tab 2 security premium as well. Now comes the interesting part, which I'm not yet covered, but I think I want to answer this well in advance. The question arises, what happens to optionally convertible instrument if your mind is working exactly the way I am making you think? Then I think you can definitely answer this as well. Can I say if the holder says, I want cash, or the holder says, no, I want equity shares? Because the option to convert is with the holder. So if the holder says, I want cash, if the holder says, I want cash, then what will happen? The money which is there in tab number 1 will get converted to the tab number 2 entirely in the form of capital reserve. Entirely in the form of capital reserve. Because if it doesn't want equity shares against it, then that money is going to be completely taken to the tab 2 in the form of a capital gain, which is a capital reserve. But if you say that he opts for equity shares in this particular case, then the money will again get shifted between equity share capital and it will get shifted to the tab number 2, security premium. Wow. I hope you're getting the clarity of the treatment of the equity component, which rests in the tab number 1 on initial recognition, and what happens to it at the end of the term. When you are converting it into ordinary shares, or the holder says, I want a cash, what is done with the equity component? So you can say that in terms of irredeemable instrument, it remains intact in tab 1. In terms of partially convertible instrument, or in terms of compulsory convertible instrument, it is split between the equity share capital and in terms of the tab number 2, security premium. And if you look at in terms of the optionally convertible instrument, it all depends upon what the holder does. If the holder says that I want a cash, then this money goes from a tab 1 to tab 2 in the capital reserve column. And if you say that the holder opts for equity shares, then the same treatment will follow. A portion goes to the equity share capital and the portion will get transferred to the tab number 2, security premium. This is very interesting indeed. Look at the treatment of the equity components and look at the financial liability elements to be taken at each stage. I hope I am pretty clear on this. Okay, I think Venkati said for optionally convertible equity component, same as partially convertible, correct. But if the payment is in terms of cash, then it goes to the capital reserve column of the tab 2. Okay, I hope I am pretty clear with the treatment of what is taken in the financial liability element 1. And what is the treatment of the equity component at the time of conversion of the instrument? That's 2. These are the 2 crucial issues which need to be careful on. And I think another thing which you need to be careful upon is that when you are looking at the accounting of compound financial instruments, remember, if there is no TC in the question, if there is no transaction cost in the question, then the rate which is used to calculate FL, the rate which is used to calculate FL and the rate which you will take for calculating the finance charge in the ledger is same. If you took a discounting rate 15% to calculate the FL, you can comfortably take the same rate in the ledger account to calculate a finance charge. The same discounting rate can be used. But if there is a TC in the question, be careful. Be careful if there is a TC, because the discount rate used to calculate the financial liability is not going to be the same what you use to calculate the finance charge in the ledger account. Here you're going to use a different discount rate altogether. Because of the TC getting adjusted to the financial liability element, you'll have to recompute the effective interest rate. So the rate which is used to calculate the financial liability element and the rate which is used to calculate the unwinding in terms of the ledger accounts is going to be different. So I think these are the 3 crucial issues which you need to keep in mind when you do the accounting of a compound financial instruments. So be careful on what elements are taken in the financial liability. Be careful with the treatment of the equity component at the time of conversion. And be careful that the discount rates which you are using in terms of finance charge calculations in the ledger and what you're using for the financial liability elements could be same if there is no TC involved, and it could be different if there is a TC involved. I think I've made myself very clear on this. Yes, Manani, great. I hope everybody is pretty clear on this. Watch this out and do these questions by hand. All the cases what we have done today, please do them by hands. You'll get a complete picture in terms of things. Now, I think let's take it further. So having done a question on irredeemable debt instruments, having done a question on partially convertible instruments, having done a question on a compulsory convertible instruments, now it's time to take you to the optionally convertible instrument. So I'm coming back to the study material now. And in the study material, we are given illustration number 31. So this is an optionally convertible instruments. And then, we are also given some information about that embedded derivative parts, which is illustration 32 and illustration 33. So that will, cover up the second area of discussions with you. Because as I started off with the fact that as far as compound financial instruments are concerned, there are 3 areas of discussion. How to identify is one, looking at the split accounting is another, and then the third area is that early redemption, which we'll come to that later. Let's now look at illustration 31. It says on 1st July X1, D issues preference shares to G for a consideration of 10 lakh. That's the proceed. The holder has got an option to convert these preference shares into a fixed number of equity instruments of the issuer at any time up to a period of 3 years. If that option is not exercised, the preference shares are redeemed at the end of 3 years. The preference shares carry a fixed coupon rate of 6% and is payable every year. And the prevailing rate of interest on similar preference share without a conversion option is 9%. Since we're making a coupon rate of 6%, whereas the rate of interest on a without conversion is 9%, definitely indicates it's a compound financial instrument. Now, since the option is with the holder, technically speaking, I should be first of all looking at that this is certainly a hybrid instrument, because the presence of the option to convert indicates that this is certainly hybrid. So I think let me just first make my analysis on this. So I'm looking at the illustration illustration 31 on the unit number 3. Now, I think first of all, we can show this analysis to the examiner as well, that this is supposed to be a case number 4. Don't tell him that it's case number 4. This is just for your understanding. So case number 4, we're looking at optionally convertible debentures in this case. So we can say it is a case where there is a non-derivative and there is a derivative embedded. So the non-derivative will be segregated in terms of FL and equity, being a compound financial instruments. For the derivative, you need to tell him that we are conducting a fix for fixed test. Because in this particular case, the option to convert is with the holder. And when the option to convert is with the holder, you need to conduct a fix for a fixed test. And in this case, we are already given that we are going to, give fixed number of shares. So I am considering that this test is pass. And if this test is pass, then the derivative is equity and there is no need to segregate the derivative. So since we are going to consider that the derivative component is equity and there is no need to segregate. So basically we need to segregate only the two components of the CFI, that is the FL and equity. This analysis also what we have done earlier when I came to the chart number 5. So I've already given you this analysis in my chart number 5. Okay, so once we identify to the examiner that we need to segregate the two components of this instrument, let's do the split accounting. So let's do the split accounting in this particular case. So now we are given that the company is liable to pay, number one, a coupon rate of 6% for 3 years, and then 10 lakh rupees is to be paid. So my proceeds are 10 lakh rupee, and we need to segregate this in terms of financial liability, and the balance will be taken as equity. So we got to pay on 10 lakh rupees a 6% coupon rate for 3 years, and we would consider a discounting at the rate of 9%. Discounting will be at the rate which is prevailing on an instrument without conversion option. So at 9%, the cumulative factor would be 2.531. So this is the present value of the 6% coupon rate we're going to pay for the next 6 years, 3 years, plus the 10 lakh rupees is to be paid at the end of third year. So at 9%, the third year factor is 0.772. So we can calculate the financial liability element of this. So 10 lakh into 6% would be 60,000 into 2.531 and 7,72,000. That works out at 923,860. And you can comfortably take the equity as a balancing figure. So that works out at 10 lakhs minus 923,860, that is 76,140 is the balancing figure. Well, my answer might slightly vary from the study module for the reason, I've taken decimals at 3 places. So depending upon you take 3 or 4 decimal places, things could slightly differ on account of that. But I guess more or less we'll be getting the same answer. Yes, I think I'm getting 75. This is 939. I'm getting 76,140. So a slight difference, but that's okay. So once you've done the split accounting for the financial liability and equity, I think we can now comfortably make the ledger account for the financial liability. So we could make a ledger account for the financial liability. So let me just give you a ledger for the first year at least. Then you can continue the ledger for the next 3 years on a similar lines. So as far as the financial liability element is concerned by bank, and this element is to the extent of 923,860. So this is 923,860. And we again do the unwinding of discount. There is no TC involved. So the rate which you've used for the financial liability calculations can be comfortably used for the finance charge calculations. So 923,860 at the rate of 9%, that's 83,147. And then we make a payment at the end of the first year, which is the contracted rate at 6% on 10 lakh rupees, that is 60,000. And we get the balance CD as a balancing figure. And this ledger would continue for the next 3 years. So 923,860 plus 83,147 minus 60, that comes to 947,007. Right, so this is how the ledger account for the financial liability element is going to be made. And thereafter, what do you do with the equity element? What do you do with the equity element? But let me ask you now, do you think in this case, the ledger balance will become zero? Do you think in this case, the ledger balance was going to become zero in this particular case? No, the ledger balance will not become zero in this particular case. So I think in this particular question, I would like to make the ledger account for the 3 years altogether and give you something interesting. So can I say in this case, I get the balance PD that's 947,007. I consider the unwinding of the finance charge at the rate of 9%. Then I make the payment of the contracted rate at 6%, get my balance CD, get my balance BD for the next year. So I think let's do this for the third year as well. So 947,007 at the rate of 9%. This is 85231. This is 85231 and this is 60,000. So let's get the closing balance. 947,007 plus 85231 minus 60, that's 972,238. This becomes the balance BD in the next year, 972238, and we can again take the finance charge, but I am not taking the finance charge now. I'm not taking the finance charge. Now watch me carefully. Now watch me carefully. I'm going to run this particular ledger account for third year twice. Let's consider that if the holder says, I want cash. And let's consider if the holder says, I want equity share, because the option to convert rests with the holder. So let's consider he says, I want cash, or he says, I want equity share. So let's see the movements which will happen in the ledger. If he says, I want cash, I will pay him 60,000, which is the contracted rate. And I will also pay the principal amount of 10 lakh in cash. I'll pay this entire amount, and this is 60,000 plus 10 lakh minus 972238. This comes to 87762 as a balancing figure. You can actually match this up that this should be approximately 9% on the opening balance. If you just calculate that, is it coming to approximately 9%? Yes, it is. So just to match up the figures quite well. In the last year, you can take the finance charge as a balancing figure, and you can make a check that this finance charge is coming to 9% on the opening balance as well. And now let's assume that he opts for getting equity shares in the company. Then what? This is a situation where we said that he's wanting cash. So if he wants cash, you pay the in return and you pay the principal. Then what happens to that equity component? That equity component will be taken to the capital reserve in tab 2. If he says, I want cash, then I already told you that that equity component will be taken to the capital reserve of the tab 2. Now, let's consider the case where he says equity shares. I will definitely pay him cash to the extent of 60,000, which is the return element. And then you will allot equity shares and record a security premium, whatever the breakup might be, and this sum total is going to be 10 lakhs. You will allot equity shares and you would also allocate the security premium, and you would comfortably take the finance charge as a balancing figure. Then what happens to the equity component? Would you like to make a guess? What happens to the equity component which is there in the tab number 1? This will be taken to the security premium. The amount which is there in tab 1 is going to be taken to the security premium. So some portion of security premium is coming from this ledger, and another component which is there in the tab number 1 also gets translated into the security premium at that stage. Great. Okay, I think I am getting some questions now at this stage. Shoma, you said, sir, when there was IGAP old AS, we used to recognize a premium on redemption as a separate item. So in our case, it is included in the finance charge? Yes. And I'll be able to explain the detailed logic to you in the next class. When I'm going to start with the aspect of amortized cost accounting logics, I'll give you why this actually came to account. And then you said it won't be zero as the principal will be ascertained on the basis of number opted. I think that gets answered, I guess. Okay, so in this particular case, we've seen both the permutation combinations, that if a company will opt for, the holder will opt for a cash, then the equity element, the equity component rests in the tab 2 as a capital reserve. And if you look at the conversion in terms of equity shares, then this gets split in share capital and premium. And the rest of the equity component in tab 1 will also go to the tab number 2 in terms of security premium. Wow. So I think all the 4 cases on compound financial instruments is well taken care. So I guess I'm not doing a summary right away at this stage. What I want you to, you practice these questions by hand, get the clarity on 2-3 agendas. When you're going to practice these particular questions, there are a few things which you should definitely keep in mind. So I think I've already made a chart for the same, but I would still advise that when you're going to make a particular, when you're doing this particular question, my piece of advice would be just be careful on certain elements. That when you take the financial liability element, what does the financial liability element comprise of? You need to be carefully that do we take principal and return? Just the principal, there is no case where just a principal is taken, at least in the questions we have done. So you need to be careful that when you consider the financial liability element of split accounting, do we take just the return or do we take the return and the principal? So typically in terms of all the 4 kind of instruments we have covered. Secondly, your focus should be very clear that when you segregate that equity component of the compound financial instruments, what is the end treatment of that? What is the end treatment of that equity component? So the end treatment is, does it get shifted from a tab number 1 to tab 2 entirely, or is it getting shifted partially? Because something gets converted into equity share and something gets converted to premium. So have a look at the treatment of this equity component at the end of the instrument's life. And then another area which you need to be careful is that if there is a TC, then be a little careful on the fact that the discount rate used for the purpose of calculating FL and the discount rate used in the ledgers could be different. So the presence of TC, could actually trigger the need of calculating a new internal rate of return as well. So do all these questions by hand, do all the 4 questions by hand, and get the focus of the financial liability calculations, the treatment of equity components, and the treatment of TC, resulting in 2 different discount rates. Trust me, then there will be no troubles at all. I hope, I trust. But what I'm going to do in the next class with you, as we meet in the next class, but before we end, I've got some MCQs to give you. I'll quickly make a summary chart on these things so that you get totally endorsed on this. And now I think it's time to do a little testing based on what we've discussed today. So I'm going to give you a total of 5-6 questions, maybe around 5 or maybe a little plus. These MC questions, try them, and then we'll discuss the answers in the next class with you. So let me give you the MCQ questions for the day. So let's begin the journey and give you some typical testing kind of questions. These are not kind of questions you will generally see in the routine. These are questions which are going to test your conceptual knowledge as well. Number 1. Can I say if I am calculating? So we can say amount in tab 1. Amount in tab 1 of SOKI. The amount in tab 1 of SOKI always gets fully transferred, to tab 2 of SOKI. I'm not giving you the answer. You know the answer very well. So I'm saying that the amount in tab 1 always gets fully transferred to the tab number 2 of SOKI. That's 1. Number 2. Then we're looking at that in terms of compound financial instruments, in case of perpetual debt instruments, In case of perpetual debt instruments, financial liability includes only return component. It includes only a return component. So the compound financial instruments, if it is a perpetual debt, it includes only a return component. Number 3. The third aspect which I'm considering is, again, in terms of compound financial instruments, can I say in case of optionally convertible instruments, in case of optionally convertible debt instruments or optionally convertible preference share, let's put it like this, that in case of optionally convertible debentures or optionally convertible preference shares, financial liability includes both principal and return. Financial liability element includes both principal as well as return. That is number 3. Let's give you number 4. In calculation of EPS, in calculation of basic EPS, I think this makes sense to ask you after doing a discussion on that. In calculation of basic EPS, we consider total comprehensive income. We consider total comprehensive income. So when you calculate a basic EPS, we are considering the total comprehensive income. You need to decide true and false. And finally, the last question on this. Can I say what enters OCI in income statement? What enters OCI in income statement goes to tab 3. Goes to tab 3 of SOCI. So we can say what enters in the other comprehensive income of the income statement goes to the tab number 3 of SOCI. So I think the last 2 questions were a little on the understanding that we've got the connect in terms of the income statement and the SOCI as well. So these are the 5 questions. I'm pretty sure if you've learned things well today, then I don't see that there would be any trouble in terms of understanding and doing these MCQs. I'll be discussing the answers to these MCQs with you, of course, in the next class. And let me see if there are any questions coming at your end. Okay, that's wonderful indeed. So I think I've already got the answers coming in from Rashmi, Aniket, and all. Okay, that's great. I think most of the answers seems to be quite correct indeed. That's wonderful. Okay, that's great, friends. So I hope you're all feeling absolutely comfortable on the concept of financial instruments covered so far. The journey is going to continue. We are still left with one section of compound financial instruments with you, which is early conversions and early redemptions. And thereafter, we'll start the journey on Indus 109 also with you in the next session itself. So I think it's time now to say goodbye to you, but please do remember to do all the questions which I give you by hand today. Trust me, you're going to feel much, much more confident in terms of things. Right, friends. So on that note, I take goodbye from you. So thank you, all of you. Bye-bye and take care.